The married put. A married put strategy consists of buying a put option and the underlying stock at the same time. The strike of the put option is the price at which the downside protection kicks in. The strategy resembles buying insurance against the stock, and the insurance ends when the put option expires. To build a married put, you need to buy 100 underlying shares as well as a put option. A trader using a married put expects the share price to rise, but fears a sharp drop in price in the short term. The ratio of this strategy is 100 to 1. If you buy 100 shares of the underlying stock, you need to buy one put option. The maximum gain is unlimited. The maximum loss is limited to the difference between the purchase price of the stock and the strike price of the put option, plus the net premium paid. The break-even is the purchase price of the stock plus the net premium paid. Let's take a look at the payoff diagram. A represents the strike price of the put option purchased. The point indicates the break-even. If the stock closes on the expiration date at a price that is higher than the break-even, a profit will be realized. On the other hand, if the price at expiration is lower than the break-even, a limited loss will be incurred. In a married put strategy, the maximum loss will be incurred when the price of the stock is less than A. Ideally, the price of the stock would be higher than the break-even. The potential profit under this strategy is therefore unlimited. Consider the example on Husky Energy, ticker symbol HSE. First, you buy 100 shares of HSE at $16.66 each. Then you buy the put option with a strike price of $16, paying a premium of 23 cents, for a total cost of $16.89 including the shares. Now let us analyze what is at risk. The total cost is $1,689. The maximum gain is unlimited. The maximum loss is $89, which is the difference between the $16.66 purchase price of the shares and the $16 strike price of the put option, plus the 23 cents premium paid on the option. The break-even is $16.89, and the option has a term of 14 days. Calculating profits and losses on this strategy is quite straightforward. Calculate each leg separately and determine the net result. The first column shows a simulation of share prices on expiration date. If the share price is below $16, the put option is in the money. The limited net loss is then the difference between the share price at expiration and the price of buying the stock, plus the value of the put option, less the 23-cent cost of the hedge, for a net loss of 89 cents. The break-even, or the price at which the strategy becomes profitable, is $16.89. If the share price rises above $16, the put option is out of the money. The profit and loss is therefore the difference between the cost of the share on expiration of the options and the purchase price of the stock, less the cost of the hedge. The potential profit is therefore unlimited.